to another edition of Financial Matters. Today we're speaking to Dylan, who was on the show before, our crypto guy. And Dylan, how are you?
I'm doing well. Good to see you again.
Good to see you again. So what's going on? How are we doing on the crypto?
I had a feeling we're going to start off with that. Yeah, crypto's doing all right. Had a nice little gain today.
Okay.
I think Coinbase was up around 13 to 15%.
Okay.
Why is that? So Grayscale has a bunch of Bitcoin in a trust, and they want to go public with an ETF, and they sued against the SEC and won.
Oh, so they're going to go public as an ETF with a lot of Bitcoin.
So,
that's fantastic.
Yeah, we'll see how the regulation goes from here on forward. But I mean, hey, that's a win for crypto, I'd say.
That's a win for crypto. Now, I know you wanted to talk a little bit about a investment that a lot of your buddies are in. Okay, so what are they? So your friends are investing in something and they want you to get involved. What's it called?
Yes, it's called Trader's Domain. And I haven't done much research about it, but just based on what they've told me, it sounds like a complete scam. I mean, they just give their money to these whoever and some offshore accounts, and then they get screenshots of what's supposed to be their statements, making a lot of money.
So they're saying they're making a ton of money. They want you to get involved.
Oh, yeah.
Well, it's kind of interesting. When you asked me about it, I actually had my team do some research. Trader's Domain reviews, and it's kind of interesting. It basically is said by many here to be absolutely a scam, not trustable. This company blocked my funds in my account, and I tried to withdraw my winnings. They didn't authorize it, and I asked for an explanation. They didn't even reply. There's just a ton of reviews here. I doubt staff on Trade Domain platform knows what they're doing. Making a deposit was easy. Getting my money out was impossible. I've been waiting 36 business days for withdrawal. I don't recommend investing in this fund. I don't believe I'll ever get my money out. It goes on and on and on. And this is just another example of an offshore get-rich-quick scheme that is not regulated by the SEC.
So is that technically legal?
Well, anybody could send their money offshore, and the SEC has no jurisdiction. I mean, think about that. You could send your money to Donald Duck in Siberia.
Sure,
the government says, hey, it's your money. This is not communist Russia.
Yeah.
And it's amazing how paper statements could get people duped. Wasn't it the whole Bernie Madoff thing?
Yeah, that's what this sounds like.
They were getting statements showing that their money was doubling and making 12% a year. And now, tell me the story, because you had told me the story where your friends couldn't get in because they said there was no room until somebody pulled money. Tell me that story.
So at first they call them up and they go through this whole kind of introduction. Of course they play buddy. And then when it comes down to time to talk business, we'll reach out in the future, but right now there's no room available. They get a little disappointed. They're seeing all these gains, and they want to get in. Calls them a week later or so. Hey, a spot just opened up, and of course they're putting even more money in now because they really want to get in and they don't want to lose their spot. And who knows? Maybe they will get their money. We'll see. But as of now, I don't think they have a dime.
And that's funny because that's right out of the Bernie Madoff playbook.
Yeah.
It's called the takeaway. It's like, well, you can't have it. You know, people would beg to get into Bernie's fund. Bernie, please take my money. No, I don't have any room for you. And then, of course, I have something open up. Okay, but he got to get in quick. And people fall for it. I just don't understand that. I mean, I look at these reviews, a little bit of homework, and you could see that why would anybody put money in this? I feel bad for your buddies.
Yeah.
Did they put in a substantial amount of money?
And I wish they'd asked me before they did this, but I mean, I'm telling them to get out or just get something back. I mean,
Trader's Domain. It even sounds sketch.
Yeah, it really does.
It really sounds sketch. You want to master your finances, from complex tax questions to planning for retirement, ensuring your wealth transfer is seamless and is protected? We've got you covered. Dive deep with Financial Matters newsletter, your guide to a smarter financial planning future. Subscribe now for insights that matter. Okay. So what else is going on?
Not a whole lot. I'm a little bit concerned with the markets. I mean, lately we've been doing well, but I'm afraid that it might be a correction going back down.
So you're thinking the market's overvalued. What are your thoughts?
I think if you go back around year and a half, 2 years, looking at where we were at there, even on a 5-year scale, I mean, exponentially the market has increased pretty substantially. But could this be the new surface, the new base that we're at? And from here, it's just kind of playing around, hitting the floor, and then kind of slowly going up and up. I mean, you're bullish?
Well, let me say this: markets are driven by valuations. So if companies keep coming and beating, in fact, if you look at this quarter, which is essentially the second quarter of 2023, 70% of companies are beating. So if earnings keep rising, prices will follow earnings because companies trade on what we call a price to earnings multiple. Now, yes, the market's trading rich, but half of the market is still trading below its 200-day moving average.
Yeah.
Half of the market's trading above. So it's the tale of two cities. What's expensive and what's cheap? Is it a trader's market to pick stuff that really hasn't moved? Is the economy really going to slow down? Is spending really going to slow down?
Yeah.
It looks like it may, but is there a hard landing coming? History tells me. I looked at the 1980s. Interest rates were 4.5% in the middle of in the 70s. Inflation started to explode. Interest rates went to 20% on the Fed's fund rate. The market that year in 1980 was up 25%. So don't tell me that higher interest rates mean a stock market crash.
Okay.
The data does not support that, because a lot of times you get inflation through demand. And what's happening is you're getting wage increases, which causes wage inflation, which is very sticky and bad. But when you give people raises, guess what they do? They spend more. Yeah. Especially if the wages are going up more than inflation. And according to the Fed, inflation's at 3.2, wages are at 4. That means people are making more than the rising costs. So there's a feedback loop that, hey, and remember, when you give wages to the poor, poor people spend 100% of their capital. Rich people do not. You know what the number one stimulus is?
What?
In economics?
What
the
is
number one stimulus is food stamps. For every dollar you give in food stamps, you get $1.71 in economic benefit. So why? Because they get a food stamp, they spend 100% of it, so Walmart now has to hire more employees, which they create more spending. It's called a Keynesian feedback loop. Okay. You don't do what we call trickle-down economics, Ronald Reagan and Friedman economics, which is give money to the rich, and the rich people will feed the poor. Yeah, that sounds like something out of the story of Robin Hood. Give me a break. The bottom line is you get demand. You give it to the poor, that's the massive stimuli to the economy. That's what Obama did. Now, I'm not a big Obama fan, but I must tell you what, he hired Bernanke, who got his PhD in the Great Depression, and Bernanke, who was the head of the Fed, said, Mr. President, here's how you're going to stimulate the economy, through demand. Give massive benefits, food stamps to the poor. Obama was being vilified for his massive expansion of food stamps, but it did stimulate the economy. The stimulus that happened in 2020 did bring the economy back to life. Now, a lot of people said that caused inflation. Well, you also had supply chain issues. But the bottom line is spending is robust. Real estate's still going up in value. I don't see a hard landing. I think, and here's what's also interesting. There's only been 4 years where the market's had 2 years in a row of down years. 4 times out of 200 years. So the odds are this year is going to be an up year if you're playing the odds. And it has been. Now, the market may level off the rest of the year, but if you were on the sidelines, here's what's really interesting. 60-40. The long bond is still down for the year. In fact, if you were in a 60-40 stock bond mix last year, you lost more than being in 100% stocks, because the long bond was down 33%. The S&P was down 20%. So your 60-40 was down more than the stock market. And this year is no better, because everybody said buy the long bond when it was at 3%. Now the long bond's at 4.10. That means the price of bonds are dropping. Now they're saying, now really buy bonds. Oh, really? Because inflation's over? Is this a ledge or a shelf?
Yeah. I don't know. You think rate hikes are going up?
I don't think the Fed's done. I don't think the Fed's done.
Yeah.
And you're getting this. You're getting these indicators that are back and forth.
Sure.
But you watched Bloomberg or CNBC, what are they telling you? Oh, interest rates are coming back down at the end of the year, beginning of next year. I am saying that that's only if we move into a recession are they going to lower rates to stimulate the economy.
Right.
But inflation's number one on their list, and inflation's still above that 2% target.
Yeah.
And I think it's going to be there for a while, which means they're going to hold interest rates higher, which is great for investing in certain types of things. When you got interest rates higher than they've been in 25 years, you can invest in things like index treasury notes.
Mm-hmm. Well, what's an index treasury note?
Well, you're taking the interest from the treasury and you're buying leveraged stock market instruments. You're getting the best of both worlds. It's the best time to invest because you have no downside if the market goes down, but you got upside if the market goes up. How could you not do that? Hello, McFly. Give me a break.
Yeah.
Does it make any sense?
No, I mean...
Should everybody be in index treasury notes?
Absolutely, yeah.
Absolutely. Are they? Absolutely not. Yeah. They're still playing this 60-40 stock market. They're still deciding whether they want to buy emerging markets or is China at the bottom? Is China a good time to buy? Because it's sure cheap.
Yeah, no, it really is.
But I don't think I want to buy China. Do you want to buy China?
I don't know, maybe. Maybe.
Maybe.
He could be like a crypto, you know, it's a bit of a gamble, but those upside.
Where China makes sense right now is if we see massive Keynesian stimulus by Xi and the Chinese regime. But I don't think the Chinese believe in that massive stimulus, that massive give that, because their real estate market, most Chinese people have their money tied up in real estate, and real estate has tanked. Half the properties in China aren't even built, and they're paying mortgages on unbuilt properties. There's whole cities that are empty in China because people put massive amount of money. The GDP of China, the average per capita GDP, is a fraction of what it is in the U.S. So even though China is the largest economy in the world, it's really it's fractionalized. So no, I would invest in China. I think the U.S. market is the best looking horse in the glue factory. I really do.
Yeah.
Other questions?
What's your opinion on commodities in terms of like if people are getting fearful, kind of going to something safer? I know you love gold.
Well, no, I'm not a gold bug, but it's interesting because I teach a master's class at the University of Colorado, and it's called commodity hedging.
Right.
And my concept of commodities is any company that invests or trades commodities should learn how to hedge. And the truth of the matter is, hedging on the commodities level is pedestrian. It's pedestrian. It's sixth grade. They're doing zero cost collars, or they're doing swaps, or they're doing put spread collars, and they're not using any type of really advanced hedging techniques. And you look at how many companies blew up hedging during 2020 when prices collapsed. Do I think you should have been hedging commodity at 125? Now, then it drops to 70. Now it's back up to 85. Companies don't hedge. Most oil companies don't hedge their flow. It doesn't make any sense at all. It's stupid. It's stupid.
No, I remember probably around this time last year when Warren Buffett invested in OXY, put like, I don't know, $50 billion or something. And I think he's pulled out about like 60% of it, at least by now. So, I mean, I don't know where oil is going in the future, but I mean, I think there's definitely some solid structure to commodities, but in terms of like, you know, being the home run as an investment, I mean.
Well, it all depends because commodity is supply and demand. It's related to weather, demand. You know, commodities used to be what we call backwardation. Now we're moving back into contango, where the longer end is more expensive than the shorter end. But there's demand, and depending what demand is, you're going to buy commodities that are driven to real estate with interest rates are booming. That's hard because as real estate slowing down, therefore we're talking about copper, we're talking about lumber. Is that a good investment now? But one thing I will say to you is the only time that real estate has done poorly is through the 2008 crisis, the banking crisis. Mm-hmm. If you look in the 70s when interest rates were exploding, real estate was still going up as interest rates were exploding. Prices don't go down, they soften. But real estate in Colorado is still up 4% year to date. We saw the mortgage rates go from 2.5, 2.75 to 7.5, and you're saying, I really haven't seen real estate come in? Well, the key to the future is study the past, as Winston Churchill once said. So if I look at the 70s and the boom of interest rates and the price of real estate, is it similar to today? I don't think you can look at '08, because remember, in '08, it was a massive collapse of
I
banking.
think that is totally different.
Nobody was borrowing. Everything collapsed. That was a total shit show. But today, real estate is still a good investment. The problem is financing your real estate, but paying cash for it, trying to steal some property when people are trying, some distressed people that can't afford that adjustable rate mortgage and are looking to get out. Maybe you can steal some stuff, but I like real estate, I always have. Any other questions?
So I'm thinking about getting into private equity. I think that there's a lot of upside potential there. I know that it's pretty big, and a lot of, not so much hedge funds, but like firms, especially in New York and even in Colorado here. And I think that there could be some serious money to be made from that.
What kind of rates are you looking at in private equity?
I mean, sometimes I'm even seeing 10 to 15% if you get lucky. Who knows? Sky's the limit on that one.
Here's the problem with private equity, and I've been doing this a long, long time, and I learned this the hard way. You get into something where the guy goes 15% a year, and it's our 5th project or 6th project, whether it's real estate, whether it's equipment leasing, and you're really excited because you're thinking, why should I be in the market if I can get 15% a year? The problem is understand that private equity is not really regulated. It's a private company that's a corporation that's making you promises, and maybe they had a good track record. It doesn't mean the past is prequel to the future. And it's hard to get out of. It's tied up for a long time. And a private equity is like a bond. Think about AAA,
right.
AA, double B, triple B. Private equity is non-rated. So it's not even C. C-rated bonds have a default rate of 40%. Non-rated, which means that and if that goes bad, your loss is 100%. You get zero back. Or they tell you you'll get money back in the next 20 years before you die. The market goes down, you lose 10, 15% in a bad year, but you don't lose 100% of your money. Private equity is not as safe as everybody thinks it is. It's not regulated. They're making you, it's a bunch of guys in an office saying, yeah, we're making a lot of money because it's working now, but commercial real estate, would you invest in a private equity that's doing commercial real estate?
It depends on the time. So what you're saying is there's no liquidity in private equity.
Well, no, they promise you X liquidity.
Right, but like let's say I wanted to get out in a few months.
But they could change, they could say, they send you a letter and go, hey, we said there's living, by the way, we're locking you up for 5 years. And you're SOL. It's not like you could call up the SEC and say, hey, you can't. It's unregulated. That's the problem. I've seen clients that have come into my firm and say, well, I bought this private equity deal and I'm kind of locked into it. For how long? Well, I don't know. And they'll let me know when I can get out of it. When they sell their properties off. Or what properties do they own? What investments do they own? Do they own a bunch of tractors that are just collecting dust and getting old? And therefore their values are dropping? What is it in? Is it in healthcare equipment that the technology is past its prime? All I know is that Goldman just came out and said, oh, we're going to force all our employees to come to the office, or we're going to fire them. How many companies are doing that? And to find good talent that wants to work from home? My firm, I'm still at 2.5 days a week that they're in the office.
You think that's good for Goldman? I mean, especially as like a client, would that be something?
They're spending probably millions of dollars on their buildings and they're going, hey, they're sitting empty. I'm just saying that looking at commercial real estate, long term, if everybody wants to work remote.
Well, what's your opinion on AI?
I think AI is going to make all my students that are going to school for software engineers and making 6 figures maybe out of a job in 5 years. So what's your major? Because I'm not sure if computer science is a good major with AI.
No, I don't know about that one. Yeah, that's why I think I might go into wealth management. We'll see.
Yeah, but what happens if AI takes over the robo-advisor? What if you don't need an advisor?
Yeah, I just feel like people with pretty large sums of money would want to prefer to speak to a real person.
A real person.
I think that's the one thing that will carry over.
With the private banking. Why? Because financial products are not bought, they're sold. And that's the truth. Think about it. Annuities, #1 product.
Speaking of robots,
highest commission. What's that?
Think about every time you talking to your phone, talking to Siri, right? I mean, how many times does she actually get what you're saying correct?
AI.
In the future, it could be better, but I mean, it's never going to be like a conversation like this. I don't think.
I don't know. No, thank you for
Yeah,
chatting. It was a
absolutely.
good chat.
Always a
Thank
pleasure.
you for another edition of Financial Matters. We'll see you next time.